A woman sat down with me a few weeks ago and she pulled out her phone. She said, Darren, my weekly run at the grocery store used to be 50 bucks. And she showed me her receipt. Same list, same store, same family, same grocery run. Last week it was $120. Then she looked up and asked, hey, what is going on? Well, I'll tell you, today's word is what's happening, and today's word is inflation. Inflation is the slow rise in the price of stuff over time. We've all heard our folks talk about when they were, young adults and gasoline was 25 cents a gallon, a loaf of bread was a nickel, etc., right? But your dollar is buying less and less every year, even when it sits perfectly still, meaning you're not risking your money in the market. It's not your money that's shrinking, but what it can buy is shrinking. That is inflation. And oh, by the way, we've been hearing a lot about shrinkflation lately, which is the price of things is staying the same or even going up just very modestly, but the size of the packaging is decreasing, right? Try buying a half gallon of ice cream anymore. You can't. Even like a half gallon of orange juice, you can't. The packages get smaller and smaller. I noticed the last time I was at the grocery store, it's the size of the cereal boxes. I mean, when I was a kid, those things were gargantuan, and now they're like the size of a keychain. That's shrinkflation, a close relative of inflation, right? Our dollar buying less and less, even when our dollar, we think, has not lost any value from a market-based investment. Okay, so here's how a financial professional speaking in some genuine Wall Street gibberish might define inflation. Inflation is the sustained increase in the general price level of goods and services within an economy over time, eroding the purchasing power of a given unit of currency. There you have it, right? And now, if anybody's talking to you like that, when you're sitting across the table for them or on a Zoom call, or they're trying to explain a concept around finances and retirement planning, and they're using language like that, please run the other way. Okay? You have my permission. Just get up, turn around, walk away. It's not worth it. Now, if we haven't met yet, I'm Darren Vilardo, the founder of Tekton Wealth Advisors, and we've been helping people just like you live their best life in retirement for almost 30 years. So let's talk about what protects you and what doesn't from inflation. Now, here's where this gets honest and a little bit real. And that is when folks find out about inflation or they start thinking about inflation, the very next question is always, okay, but what do I do about it? And here's where the answer gets a little bit shocking or surprising, because the things that feel safe are usually the things that aren't safe, and the things that feel risky are usually the things that protect you. But let's start with what won't protect you from inflation. Yeah, this is going to shock some of you. Your cash sitting in your checking or savings accounts paying you 0.5%. You're not keeping up with inflation. You think it's safe, but you're actually losing purchasing power. You're not protected against inflation risk. That big pile of money under the metaphorical mattress, those don't lose dollars. That's why they feel safe, but it loses buying power quietly every year while you sleep. All those instruments where you're earning a very, very low yield in exchange for the perception of safety. Your bank accounts, your CDs, your money markets, likely not keeping up with inflation, even though you're not losing value on the statement, you're losing value based on what your dollars can buy. Now, here's what actually protects you. Growth, ownership, things that have a chance of going up at least as fast as prices do. Stocks, real estate, a business if you own one, assets that participate in the economy instead of just sitting next to it, watching it pass them by. Here's the punchline, folks. The most expensive financial mistake of the next 30 years won't be losing money in the market. It'll be playing it too safe to keep up. Let me say that again. The most expensive mistake that you'll make won't be playing it too safe. It will be not participating in the upside. Not participating in the upside. You've got to have some exposure to growth to keep up with inflation. Okay, so here's why this matters even more in retirement than at any other time of life. Most folks plan for the type of lifestyle that they want on the day they retire, what I call a cocktail napkin retirement plan. Hey, I'm going to get it from Social Security. Maybe my wife's going to get some Social Security. Maybe there's a little bit of pension out there, and you go, oh, I'll just take the rest out of my 401k or out of my IRA to make up for, the shortfall. And that's great for the first day, the first month that you're retired. But what happens in 5 years, 10 years, 15 years as inflation eats away that purchasing power? Almost nobody plans for what that same lifestyle will cost them at age 75 or at 85. And over a 30-year retirement, the price of the same lifestyle will more than double. The same groceries, the same trips, the same medications, twice the bill. Your plan has to be built to fund both versions, the one at 65 and the one at 85 and beyond. So here's the question I have for you today. If everything you spend money on, your groceries, your healthcare, your gas, your gifts, quietly doubled in price by the time you turn 85, does the plan you have today still work? Ooh, come on somebody, that's strong. If everything you spent money on quietly doubled by the time you turn 85, would your plan still work? See, most folks think the biggest risk in retirement is the market going down. And that's certainly true if you're not prepared. But the bigger risk is the quieter one. It's prices going up while your money stands still. If you've never built a plan that accounts for that math, then that's a conversation worth having. At Tekton Wealth, we serve people, not products. I'm Darren Vilardo, the founder and primary advisor here. Now, next time, we talked today about the force that's working against you and your money, and that's inflation. But next time, we're going to talk about the force that's working for you and your lifestyle. The single most powerful idea in personal finance, often called the eighth wonder of the world, and that is compound interest. Thank you so much. God bless.